morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. You're watching Indian Open. I'm Neeraj Shah. Good morning, Neeraj.
Good morning, Neeraj. You've got a heavy day of activity here on the equity market, so let's get you started with the headlines this morning. Indian markets look set to extend the sell-off. The SGX Nifty trading more than 1% lower. 50 individual stock futures start trading on the Singapore Stock Exchange from today. It's a two-way race for Bhushan Steel. JSW-led consortium and Tata Steel are the only ones to submit final resolution plans. Singtel pumps in another 3,690 crore into Bharti Telecom, Airtel's holding company. And Tata Motors and Bosch are the two nifty companies out with third quarter earnings today.
Well, if only all of these would matter to trade today, doesn't seem like that will be the case. The SGX Nifty already showing a percent downtake. And frankly, we'll talk about the global markets as well, but what the US markets did and the global markets did in Friday, what the Asian markets are doing today, wouldn't come as a surprise that we'll start off lower. The question mark only is, how much further do we extend these losses? I think the question mark about whether we lose today or whether we'll bounce back is out of the question. People are now only talking about how much further can this last, and frankly, there are no answers to that as of now. The trade setup, and just look at what's happening in the Feb series until now. I don't think we're seeing too many short build-up, too much of a short build-up on the FNO side as well. Nifty and the Nifty Bank, the open interest only fell in Friday's session. That shows that there is a continuous process of long unwinding that is there in place. Sure, some shorts would have taken place, but a larger trade is still of long unwinding, and that may well get exaggerated in the session today. You would argue that over the last two sessions, maybe some bit of longs have been taken out. But remember, the rollovers, the long rollovers into the series was fairly high, and that may well continue. Cash market volumes too. I think on Friday, unless I'm very wrong, we saw some of the highest cash market volumes seen on the National Stock Exchange. And while you may argue that FIs bought in a little bit, but frankly, these days with these kind of trades, the fund flows don't really matter too much. Don't get excited by looking at the FI numbers, saying that despite the LTCG, despite the market fall, FIs have bought. These things could change in a matter of days, to be honest. And Ida, the global setup too. The Friday data that has come out certainly doesn't augur well if you are an equity bull or an EM bull, because everything that came out from the US, according to my mind, and you probably have a better insight into this, but point towards the possibilities of higher yields, and the markets certainly are not prepared for this, even if they've been talking about it.
It's good news, bad news, right? It's great news for the US economy because you're finally seeing wage growth pick up. I think 2.9% growth year on year in average hourly wages is the best since 2009. So it's telling you that the strengthening of the US economy is a solid story. So, that's on the one side, and you benefit in terms of trade, demand from the US, etc. But the flip side to it is, as you're saying, changes on interest rates are starting to get readjusted. Our expectations of changes on interest rates are readjusting. So people are now talking about the need for 4 Fed rate hikes this year instead of the 3, which has already been built in. And remember, these 4 rate hikes must always be talked about in this year's context against the backdrop of the unwinding of the Fed balance sheet, because that also pushes up rates, right? It may not push up the Fed funds rate, but it pushes up yields in the market. So the two together is why you finally started to see a significant move up in yields. I think 284 or something on the US 10-year. Everyone has said that 3% is the magic number. I don't know that is or not. Technically it seems, a lot of people, including Bill Gross, believe that 3% is that number, and you're inching closer to that. But even if you, take that 3% mark and discount it a little bit, you look at the move up, and that chart that you see, you've seen a considerable move up in US bond yields, and that has to then readjust expectations on the equity side as well. Yeah, and a sharply rising dollar as well. Hitherto, the dollar has been falling. Friday was probably one day when we saw the dollar index really move up. Yeah. What happens if it continues to rise? I think so I think it's a yield-driven move. So we watch yields before we watch dollar. But as you've been saying, right? The bonds, then the currency, then the equity markets. In this case, in this scenario, because it's rates-driven. But it certainly seems to have riled markets, right, across the board. Big time. Actually, just your opinion as well. While we're talking fundamentals out here, I think there is a very interesting technical chart that we put out on the dollar yield as well, and it's chart that dates back to decades. And there you can see this is from, this is a multi-decade chart, but the channel starts from about 1985 or thereabouts. And there you can see there is a strict channel that the yields have maintained. It's finally starting to break up over the upside. Just that this is a quarterly chart. So you got to probably look at 2 quarters performance. And if indeed by March end or by June end, if the trend moves up, then
technical chartists will say, okay, that's a decisive breakout. They'll be too late by then, I'm sure. But it just shows that hitherto we've been in a band, and the question marks would be raised about what happens if this indeed goes out of the band. So that is one. And yeah, equity markets are certainly not liking it. Ira is right. I mean, I don't think credit markets have liked it for the last few times. Equity markets are now finally tasting facing some of the music, and emerging markets as well. We've been talking about how, I mean, this US 10-year yield rise doesn't only impact the US equities, right? If the mother market falls, then our markets will correct. There is no way that it will be hidden from this. And just keep in mind that our markets have already corrected. We may talk about the headline number down only 400 points. The small cap index is down 15% from the recent high. So that's not an average correction. Last week, 7%. The weeks before that, we've already seen a 7% pullback at the small cap end of the market. So our markets certainly have corrected. For whatever it's worth, just before we get started on, first word, just 2 or 3 names that I thought, or a set of stocks which will react today. I don't know if even the good results will be rewarded positively, but just need to keep these stocks in mind. Maruti Suzuki is important from multiple perspectives because there is a Suzuki board meet today to approve their quarterly numbers. That is not important. What is important is that in this board meet, there is a very high probability that Suzuki may approve new royalty terms which Maruti had proposed, and Maruti in the call had said that they will come out with these terms only when Suzuki board meet happens. Yatin will talk a bit about this, but this is important from a Maruti Suzuki shareholders perspective. There's a very weak Q3 from Vinati Organics, and I pulled this stock up because specialty chemicals by and large have done well. This stock has rallied quite a bit, and it's not been a great quarter. This stock will correct today. And there are 3 very strong numbers. Let's see if they are able to withstand the selling pressure. 3M India, Thomas Cook and Thyrocare in particular, exceptional numbers. Let's wait and watch if these stocks are able to withstand, as I said, the selling pressure. But it's all about the equity markets, really. We may go on and on about what specific stocks could do, but I believe today, more so than ever, it's more about how much can some of these stocks withstand the selling pressure. The SGX is already showing a 1% downtick. I don't want to sound to be alarmist, but just one last point. If you look at the WEIF function on the Bloomberg terminal and show the US equity futures, the US Dow futures, as of now, are already hinting towards a 200-point downtick. Whether they recover or not is another thing, but they fell on Friday's session. They are hinting towards some bit of downtick today as well. So there's pressure from across the globe. Difficult to say if we'll withstand this.
All right, Neeraj and his team will, of course, be on the equity market action through the day. Just stepping back and looking at some of the other important stories, and there are actually a whole bunch of them here on First Word today. The Singapore Stock Exchange has gone ahead and started trade in 50 Indian stock futures, and the NSE is not going to be too happy about it. Sajid Mangat here with us to explain why this is important. Vishwanath Nair will join us with all the details of the bids that have come in for Bhushan Steel and the behind-the-scenes action on that particular account. We'll talk about the 33 nifty earnings that have come out so far, that discussion and what that portends for markets also here on First Word. And finally, we'll give you a wrap of the automakers' numbers and how they have fared in this first month of the year.
Okay, in a move that could move futures trading volumes abroad, the Singapore Stock Exchange has launched single stock futures. Now, this was a much anticipated event. A lot of stories filed on BloombergQuint.com about what the NSE was wanting to do. Remember, NSE earlier wrote to the SGX seeking to delay the launch as well. Now, Sajid Johnson with the trading parameters on these futures on SGX, and what maybe this could mean, some bit of forward gazing on what this could mean to stock futures trading as we know hitherto in India. Or for Indian stocks. Sajid, good morning.
Good morning. That's what is going to happen, because what we are going to see is like this thing, SGX Nifty going to give us an indicator. The SGX single stock futures will give us an indicator of some of the index stocks, how they're performing. Now, today is the first day. We just seen 4 counters getting open, getting bid and ask for those counters, which includes ITC, ICICI Bank. You have Ultratech Cement, which is coming in, and one more counter which is there. But ITC has done some volumes there, but other volumes are yet to pick up. But it's just the first day. You will see as we go closer to the market opening, you will see some trades happening on them. The positions being taken. You have a lot of positions which are already built up in the domestic market, and that would, I assume, that over a period of time would move on to Singapore futures. And that's one of the concerns which was also discussed at the board meeting of Stock Exchange on Friday. The exchange had a board meeting, and the board deliberated on the risk which is coming from as a result of this. But what I understand from my sources is that while the discussion happened, it all went down to the extent of saying that now it's for the government to intervene between, and it's a government to government thing rather than the exchange can do anything about it, because they don't want to take a unilateral action which will be taken, which will be perceived as anti free trade or kind of thing, and the relationship with Singapore is very good. For India, Singapore's relations are very good, and they don't want to bring in such kind of uncertainty or any issues in that, and they are very wary about it. So it is going to be taken up by the government as and when they have the bandwidth to do it.
Sorry, why would the government intervene in this, Rajat? I mean, they didn't or couldn't intervene in the fact that a lot of your currency trading moved to the NDF market, and that is a very sovereign risk related element. Why would they intervene in individual stock futures?
Well, the expectation from the NSE is that before we take an unilateral action, the government should intervene and try to get a resolution here. Because if NSE comes out with a action, it would be perceived as anti-trade. Simple in that sense, and that would would be a counter narrative to the government's entire thing about India open for business, and that's one thing. The biggest challenge for NSE is that the entire market is going to shift there, and if entire market is going to shift to Singapore, like we're going to see in the next 1 or 2 months when volumes start picking up there, then this the entire derivative market as we stand as it is in today, it's going to be governed by that. The control of the government or the regulator on that market is nil. If you look at the specifications which have come in, is a dollar denominated contracts, so there is no translation risk for any of the FIs, so they directly come in there. The capital gains and everything is very sorted in Singapore as compared to here. Now we have an LTCG which is coming in. The transaction cost is much lower. The transaction charges in India are considered to be lower, but when you add SCT to it, the transaction charges cost goes up.
There won't be a tax arbitrage, right? I mean, futures trading anyways would have attracted 30% speculation income. So I don't think that would have, I mean, LTCG wouldn't have had an impact, right? But more importantly, just the volumes moving up. I mean, with the futures, SGX futures volumes, SGX futures took away a lot of NSE cash, NSE futures volumes. This is what single stock futures could do. Is that what you would expect?
So the single stock or SGX futures open interest, which was around $9 billion, is much more than the open interest FIs have in India for index futures. Now, we expect that at least 50% of that volume and open interest is going to migrate there. Singapore is a tax compliant regime, a very strict tax compliant regime there. It has, and for that matter, people who are investing, they would get much more incentive, because many of the fund managers are located there and they're working out of it. Remember, last 2 or 3 years, government has been trying to bring in the fund managers to the domestic market. There have been policies in budget saying that, okay, you come over to India, why are you trading from Singapore? Now you have the market moving to Singapore. Why should they come to India?
True.
All right, interesting stuff there, Sajid. Thanks so much. Sajid Mangat flagging off what will be an interesting market to watch actually now for the next few months. Let's move on to all the action in the stressed asset space. Action is only going to pick up as we get to, say June or so, as all of the large stressed assets come up for bidding and resolution. Well, Bhushan Steel was forced off the mark, and the deadline for final resolution plans was Saturday. Vishwanath Nair is joining us, telling us what transpired out of that bidding deadline. Vishwanath, what did we pick up?
So, Ira, what we understand from our sources is that 2 domestic steelmakers have ended up putting in their final bids for the Bhushan Steel resolution plan. One is, of course, Tata Steel, which has been pretty active in the stressed asset space, and they've been looking at various options. A number of these large steel companies that are there, SR, Bhushan, all of the works. There's also the second bidder, which is a consortium that is led by JSW Steel. This consortium is a 50-50 sort of joint venture between JSW Steel and a fund that is promoted by the Piramal Group and Bain Capital. They've come together, and according to what our sources are telling us, the JSW part of the bid is at about 25 to 30,000 crore. we haven't been able to ascertain what the Tata Steel bid is going to look like. It will come to light only by Tuesday, which is when the resolution professional in this case, which is Vijay Kumar Iyer, who's from Deloitte, they will, whenever he opens these bids on Tuesday, that is when some of these details will come to light. But as of now, we know that what JSW has bid is closer to 30,000 crore, which is about double the liquidation value of 15,000 crore that was determined for Bhushan Steel. Now, it is important because Bhushan Steel is easily one of the largest cases, that is among the 12 large cases which were sent to the NCLT for insolvency procedures in June last year. So Bhushan Steel owes its financial creditors over 56,000 crore and about a 600 odd crore to its other operational creditors. So it's a large account by all measures, and whatever happens in this is going to be washed out. Interesting because only 2 people have actually finally bid, because about 5 odd steel players were looking at this case. There were international players like ArcelorMittal as well as Vedanta who were looking at a possible sort of investment in Bhushan Steel, but none of that came through by Saturday. Only JSW and Tata have put in their final bids. There were some stories about ArcelorMittal having put in a bid, but the company and the spokesperson has confirmed to Bloomberg Quint that they did not in fact submit any bid, and they will be looking at India as an opportunity going ahead.
All right, Vishnath. So, 2 points. One, of course, yes, there is a narrowing of the number of bids. But if you look at JSW's bid at about 25-30,000 crore, double of liquidation value, they're getting enough money. Just a quick question, Vishnath. So, from here, what happens? I think you had done a story last week as well, saying that bankers are trying to finalize some sort of standard operating procedure on how to deal with these bids. So now they negotiate with only one party, which will be the highest bidding party.
That's right. So this is something that happened last week with the Indian Banks Association. Bankers got together and they came up with sort of bidding, core guidance to lenders, wherein they decide what exactly they want to do whenever bids come in. And as part of that, there's this point that they will only be negotiating with the highest bidder. So these negotiations will, sort of clear the path over the next 6 to 8 weeks, and which is by when, at the end of which, we will know what kind of resolution plan will finally be implemented in Bhushan Steel. There are some other pointers as well. If the lenders are not happy with the whole bidding process or the bids that have come in, then they can call for a rebid. So that will sort of push back this whole process because there is a 270-day deadline within which you have to finalize the resolution plan and implement it in the company, failing which the company will go into liquidation. So, it is very time sensitive in that sense. So what will happen is something that we will have to watch. By March, April, we are assuming that there will be some sort of clarity as to what exactly the resolution plan is going to look like.
All right, Vishnath, thanks so much. That's Bhushan Steel. Lots more coming up over the next few weeks or so.
Yeah, this space continues to remain exciting for sure. Now, we've been talking about how the market is under a bit of a tizzy. The respite, though, for an Indian investor would be that while we are halfway through the third quarter earnings, and while financial and tech companies seem to be doing better this time around, the overall picture probably doesn't look so bad. But let's get in Darshan, who will actually tell us whether it's looking bad, whether it's looking good, or whether it's par for the course. Darshan, what's the trend so far? Good morning.
So the trend, what we've seen over the past few quarters is that the company reporting mixed or inline set of numbers have moved up drastically, while the extremes either on the strong side or weak side have been coming off. So at least 33 companies of the Nifty have come out with results this time around, out of which 19 have been in line with what the street was anticipating. So it's not been a bad earnings season. Now this is the trend. So if you look at the fourth quarter last year, from an inline, look at it from, this is in comparison to the 33 numbers that have come out, have moved up from 12 to 13 to 18 to 19. And look at the companies which are reporting strong numbers. They've come down from 16 to 8. So they have halved. So the company's outperformance is clearly out of the window as far as the earnings season over the past few sessions are concerned. Now take a look at this. So the yellow gives an indication of which are the companies that came out with numbers in line with estimates. So most of the private banks, most of the FMCG companies feature among these companies. So let's take a look at some of the trends or some of the companies individually. First of all, UPL is the only agri company in the Nifty, and that was a big disappointment, and the company stock fell in almost almost 8% post the numbers that came out. The other trends that we're seeing is, Ultratech. Strong volume growth, but EBITDA per ton disappointed. So that was the case as far as Ultratech was concerned. The other one was the telecom company, the Bharti group of company. As far as Airtel was concerned, it was a weak set of numbers. Average revenue per user came down drastically, and operationally strong number for Bharti Infratel this time around. The other set of numbers that we're looking at is Dr. Reddy, the only company in the pharma company. Now, the numbers were decent, in line with what we had anticipated, or probably even stronger. But the counter fell in significantly because the US outlook was very, very weak. As far as the FMCG space is concerned, strong volume growth was seen in HUL, and volume growth disappointment as far as ITC was concerned. But nevertheless, both of them came out with numbers in line set of numbers. Maruti, the numbers were in line, but the stock did rally on the back of lower royalty payment issue that was discussed this time around. So that was the case with Maruti. Reliance Industries was the big one. Jio posted a profit this time around, and that was positive for the counter, but refining numbers were very, very subdued. The other one is the private sector banks. All the private sector banks except for ICICI met the street estimates. ICICI was slightly weak. Asset quality remains stable across the banks at this point of time. So these are the broad trends. As far as NBFCs are concerned, very strong set of numbers. Bajaj Finance came out with a strong set of numbers, and in the housing finance space, HDFC and Indiabulls Housing Finance, both of them came out with a strong set of numbers. IT, no change. All the top 5 companies met estimates. There were no surprises. Guidance was maintained. So in inline set of numbers from the IT space this time around. L&T numbers were strong. Order inflow was extremely strong for the company, and the counter did manage to rally post the numbers. So among the only construction companies to come out with numbers, decent set of numbers. As far as Z is concerned, Z met estimates. The ad revenues remained strong, and a one-off expense because of 25-year celebration hit the margins of the company. So that's the general trend that we are seeing as far as, the numbers are concerned, but the majority of them came out with numbers that met estimates, and the trend of strong outperformance has come down significantly over the past 4 quarters.
Well, thanks a lot for that, Darshan. So that's the Nifty 33, as if I can call it that, earnings season so far. Of course, at the end of the earnings season, we'll do a complete analysis of how the quarter has gone by. But let's do a complete analysis of how the month of January was for the automakers. They apparently have had a good month. Sales have grown in double digit for all the companies, while some of it can be attributed to low base as well. But overall demand apparently has been quite encouraging, Yatin.
Clearly, Neeraj, in a very strong month of January for most of the auto players. And if you look at the two-wheeler sales numbers, and they are coming up on your screen, clearly a 40 to 30% kind of range is what they have posted. Bajaj Auto, 46% growth. Hero MotoCorp, TVS Motor, Eicher Motor, all of these companies, have been reporting numbers which are showing a growth of 30% growth on a year-on-year basis. Of course, more or less, the entire figure is same for all of these 3 large two-wheeler makers. Of course, the surprising point was the commercial vehicle segment, wherein we are looking at some good growth coming in. In fact, if you look at Tata Motors, aided by, of course, the medium and heavy commercial vehicle segment, we have that sales which saw a growth of 43%. M&M and M&M tractors, so the automotive segment on the back of good UV demand as well as the tractor sales continue to grow over 30%. Maruti, of course, was a slight bit of disappointment with growth coming in only at 5%. Of course, there are production constraints and long waiting period still for their new models. Of course, if you look at the key reasons which have been, moving the sales growth is the strong demand for Brezza and Baleno for Maruti Suzuki. If you look at Tata Motors, of course, as I was mentioning, the commercial vehicle segment continues to do well, but in the passenger vehicle segment, we have the Tigor, Nexon and Hexa. All of these 3 passenger vehicle models doing really, really very well in the marketplace, continue to get good order books from the marketplace. Of course, we have the logistics and infrastructure sector, which has been aiding the overall growth for companies like Tata Motors in the commercial vehicle segment, and ditto is the case with Ashok Leyland as well. Of course, the two-wheeler markets, surprisingly this time, we have seen a strong rural demand coming in for them. So it's not only urban, but the rural demand continues to be strong for the two-wheeler segments, because of which we are looking at a good growth, on an overall basis. So, everything said and done, commercial vehicle segment, passenger vehicle segment and two-wheelers, all of these segments do well. Of course, the passenger vehicle segment has shown some moderate growth, but of course there is growth and there is demand.
Okay. Yatin, just a follow-up question. Auto sales notwithstanding, there is also an event for Maruti lined up today. I believe the Suzuki board meet. What would it mean for a Maruti shareholder?
So Neeraj, we have Maruti Suzuki in its conference call told management, the management told analysts that they have revised the terms of royalty with Suzuki Motors, and Suzuki Motors now needs to approve the plan which has been submitted by Maruti Suzuki. The board of Maruti said that the royalty terms are much better than what they are, versus what they were. So clearly the royalty payout will be much lower. The new models already are billed in rupee terms, so the yen volatility already goes away. But now in that rupee payment of royalty also we have some lower anticipation of royalty payouts by Maruti Suzuki. Today Suzuki board meets for their annual results as well as quarterly results, and probably there is a very high likelihood that they might take a decision there on the royalty structure with Maruti Suzuki, which is its subsidiary. So of course we'll watch out for that one. What kind of an impact does it have is to be seen, but on an overall basis it seems like if there is a favorable term or a favorable rate for royalty from Suzuki, the stock should react in due course of the day once the announcement is made public.
Okay, let's wait and watch. Expected in the first half, I would presume.
Yeah, most likely, because the Japanese are anyways ahead in time,
cool.
Almost 2-3 hours before us. So probably there is a high likelihood that they might come in with a plan before the market does.
Okay, let's wait and watch if that happens and when it happens, rather. Thanks a lot for that, Yatin. So keep all of these in mind, but that's the summation of the top stories that we have on First Word today. I dare say Ira at the end of it will say, keep an eye out on the yield.
This time global. I think domestically, Friday was a slightly calmer day, so let's hope that it stays that way.
Okay, let's wait and watch. Cool. But we'll talk about all of this and more importantly, markets and macros with Andrew Holland of Avendus Capital Alternate Strategies. And the big voice of the day, we'll talk with Ramesh Damani of BSE about what he made of the budget and what he makes of the market meltdown, more importantly.
आइसक्रीम ये है डबल आनंद। पहला आनंद पॉलिसी टर्म के अंत पर मैच्योरिटी क्लेम का पूरा भुगतान, और दूसरा आपके अपनों के लिए लाइफ कवर की पूरी रकम बिना किसी प्रीमियम के। LIC न्यू जीवन आनंद, आनंद ही आनंद।
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
व्हाइट शर्ट्स कितने प्लेन और सिंपल। फॉग सेंट प्लेन और सिंपल व्हाइट शर्ट को बना दे स्पेशल और फैशनेबल। फॉग सेंट, न्यू फैशन वेयर फॉर मेन।
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
back with Indian Open right here on Bloomberg Quint. The SGX Nifty has shown its hand, it's trading down. I just want to point, while the rest of the Asian markets are also looking weak, and that entire Asian picture will come up on your screen. Nikkei, Shanghai, etc. Everything is trading very, very in a wobbly fashion. But keep in mind there is pressure across the world, and we'll see pressure a bit later on in the day as well. If the Dow futures are to be believed, as of now, they're trading almost 200 points lower. So that's the futures trading on the Dow, and that is looking wobbly as of now. S&P 500 as well correcting. Nasdaq too is probably not spared right now. So there's a bit of a downtrend that's happening in the mother market. There is no way that the other markets will escape this. What are futures market for India trading telling though? How is the build up like? Navneet Saluja is standing by with the FNO setup. Navneet, good morning. And seem to be that there aren't too many shorts. This is still a case of long unwinding.
So far, yes, Neeraj. Good morning to you. And as you rightly mentioned, we've been seeing unwinding for both Nifty and Bank Nifty. Now, I guess more of short positions have been taken on the option side. We'll take you through that data. But before that, just want to highlight the SGX Nifty has slipped below the mark of 10,600. And for the day, actually, we would be watching out for the 50-day moving average of Nifty, which is somewhere about 10,545. Remember, on Friday, for both Nifty and Bank Nifty, we did close below the mark of 20-day moving average. Also for the Nifty futures, discount of 4 points vis-a-vis premium of 14 points was seen, unwinding of 4% when it came to the open interest. Let's quickly pull up the Bank Nifty futures, where once again unwinding continued for the 4th or 5th session. Still, they closed with a premium of almost 53 points. And post an event, actually, we did see the India Volatility Index surging very sharply, 8% higher, closing above the mark of 15.2. Let's tell you how the put-call ratio right now stands at. For Nifty, it fell to level of 1.08, when for Bank Nifty, it's way below the mark of 1 to about 0.7. Let's tell you why the PCR fell. Pull up the option strike. There is heavy amount of call writing which is taking place in the system. The green bars are your call strikes and the red bars are your put strikes. So unwinding seen. Clearly, the put writers have been running for cover for 11,000, 10,900 strike. And as you can see, the 11,000, 10,900 and the 10,800 have strikes have seen huge amount of call writing on Friday's session. What are the FIs doing? Well, clearly, surprisingly, in the last 2 sessions, they've been buying on the cash segment, but on the FNO side, they did unwind their long position. Just want to highlight this data. When we started the series, they were 80% long on index futures, and now the figure has come down to 66%, and they created fresh shorts on the index. Full of the options data, that's very interesting for the day. Heavy amount of shorting was seen. Look at this. We don't see these sort of contracts being added on daily basis. Put long and call short. These both are your short positions which the FIs have taken to hedge themselves against their cash portfolios. Just want to highlight few stock futures before I wrap. There are new stocks which have entered into the ban. HDIL, India Cement, watch out for that. And one counter, Jain Irrigation, has come out of the ban. The counter was down almost 8%. And lastly, the eyes will be on PC Jewelers after the counter fell almost over 50% in the intraday session. But the positions which were taken during the day, they were unwound because there was long unwinding seen on Friday's trade, Neeraj.
Maybe some stocks will be happy they are in the ban period, considering the trend of the market. So it's the reverse psychology that works. Navneet, thanks a lot for putting that into perspective. Abhijit Pathak, Director at Definite Solutions, joins us on the show. Abhijit, good morning. Thanks for joining in. What's your sense, Abhijit? There are definitive hedge positions on the short side that have been taken by institutional investors, and no, I mean, it's not really any prizes for guessing that the trend looks weak. The question is, what would you as an experienced trader do when the market opens down at least about 1% from what the SGX Nifty is indicating?
There are different scenarios possible, because it's very difficult to say where it will open. That will be number one. Number two, how much further down it will go. And then there will be an intraday recovery till what level it goes. But at the same time, as long as 10,550 on the spot is held, 10,540, 10,550, I don't think it will decline further. That is number one. But number two is what one should do. I mean, if someone is holding longs and he has a problem with his account size, then I'm afraid there is a problem. But if someone is holding shorts, he should look at 10,550 and book there if it is not going below 10,550.
You think there is an outside chance that we may not really correct too much, Abhijit?
I will be surprised if it closes below 10,550. I'll put it the other way. In fact, I would suggest near 10,550, 10,580, one should buy a 10,800 call.
Wow. So you don't think that this is an intermediate downtrend, Abhijit? You working with an assumption that, or you're working with a thesis that at these levels the markets will take a pause and show a bounce back?
Yes, in fact, everyone is looking at Dow and S&P futures. Even that, I'm looking at it in the morning. I saw the charts. It opened gap down, but even that is at the support. I think it is 2640 on S&P futures, and that is a very strong support around that level. So I don't expect markets to have topped out immediately as of now. And the other logic which I've been using is if you see all the markets, how they behaved in January. There was a huge rise in the US market as well as the Indian market. Unless that is completely retraced below that, then only I'll become bearish. Till that time, as I said, 10,500, 10,550 might be a support, and we might head higher again. It might take a couple of days to stabilize because there'll be a lot of margin calls after 10 o'clock today. So that's why it might be a bit risky to take futures. But there will be some stocks which will show strength in this.
Okay, one more question, Abhijit. Would you play this bounce as only as an intermediate bounce? And my question to you is there a long-term trend that has developed or an uptrend that has been disturbed for the foreseeable future? There's somebody who put out a note saying that in an X number of stocks on the BSE 500, maybe about 323 stocks are now trading sub the 50-day moving average, so the uptrend has been broken, etc. Have you looked at any of such analysis?
Yeah, but I look at only at the Nifty. As I said, the January lows, which is near 10,400. As long as the Nifty is above that, the uptrend is still intact. There might be a pause, there might be consolidation, there might be up and down movements. But as long as on a closing basis 10,400 is held, this uptrend is still intact.
Okay, Abhijit, lastly, what's the stock-specific call if there is one today?
Again, it's going to be a long call because, there's no point in taking a shot at the lower level. So I'm looking at Hindalco, which had a low near 230, 235 in January. If that is held, that can be a good long. It can go back towards 260, 265 in the coming days in February.
Abhijit, thanks a lot for that. Thanks for joining and giving us that perspective. Now, viewers, keep in mind, I think our conversation will veer towards what to do in a scenario like this. No alarm bells, no need to panic, really. But if there is the mother market correction that is on, will we escape that? No. The question mark only is this a top and will we see a reversal down towards scary levels, or can there be some intermittent bounces or some supports that the markets will take because the micro seems to be improving? That's ideally the kind of questioning and the kind of answers that we would want from our guests as well. Rajat Sharma, CEO at Sana Securities, joins us right now on the show. Rajat, what have you been telling clients to do since Friday morning?
Yeah, good morning, Neeraj. Since Friday morning, a lot of clients have actually called in to find out, if they should sell off their stock holdings temporarily, because, the sentiment seems to be, or the general view seems to be that there could be more selling until 31st of March as, people try to book out some profits, to, avoid paying capital gains. And anyways, the markets have been overvalued and, advisors have been advising clients to take some money off and invest it in fixed income or debt kind of instruments. Look, my sense is that fundamentally there's been no change since Friday. Markets had been overvalued, they still remain overvalued. Tax cut or tax raise alone has never in past broken, a momentum of the market. If at all, higher taxes just indicate that, the government is confident that, the markets will be able to absorb that. US markets have been falling again on fears of interest rates being raised 2-3 times this year. So both of these news items show is that the authorities who are responsible for, if you may for this fall, are actually doing things which kind of highlights that the markets have been very strong. Liquidity position has been very strong, which is even now very, very strong. If at all, if you look at the earnings that have come out so far, you'll see, a lot of companies, a majority of them, I think around 70% or more, would have reported profits in line or stronger than what the market was hoping for. I will say this, that, these temporary disruptions, as I said, my sense is this won't last very long. But people may withdraw some money, but, eventually they will deploy it back in the same market where they're withdrawing. But what you may see is there could be some change in the sectors from where the money gets withdrawn and then where it gets deployed back. Personally, I have, liked IT for a very long time. I think that's one sector which you'll see in this temporary disruption and bounce back. You'll see a lot of IT stocks will do well. A lot of money may actually get withdrawn in pharma if this trend continues for a bit. So we're not actually advising any clients to take much money off the table and sit on cash for some time. To the extent that we were already maintaining some debt portfolio, we'll actually keep holding on to that. But yes, we have moved money from some of the stocks and bought into some of the undervalued sectors, as I'm talking about.
You're not sitting on too much of cash.
No, I mean, to be honest, today we are sitting on about 25-28% cash, but then that's what we've been sitting on even when the market continued to rise. And by cash, I mean it's invested in a fixed income kind of securities for most portfolios. Okay. We've not increased our cash allocation around or after this fall.
Okay, get your point. Rajat, stay on. So much more to talk about. That's the market perspective. We'll get in our research team at the research huddle to talk about all the key stocks that should be in focus. Yes, the market is correcting and the SGX Nifty is corrected even further. But beyond the headline numbers, there are some specific stocks that should be at the top of your radar. Some stocks and news, some results that will come out today. And Nikki, Shraddha and Yatin join in. Let's start off with the stocks and news first.
That's me. So Bharti Airtel, of course, will be one stock which will be in focus. This is after Singapore Telecommunications said that they will invest 2,649 crores in Bharti Telecom, which is the parent company. Now, with this investment, Singtel's economic interest in Airtel will rise by 0.9% to 39.5%. GMR, where its subsidiary will acquire additional 11% stake in GMR Hyderabad International Airport for about 484 crores. You have an ET report which suggests that JP Power Ventures has offered to sell its Nigri project to NTPC. So let's see how that name reacts. Orchid Pharma is another name to track. It's almost like a penny stock now, but there's an ET report which says that Blackstone, Strides and Nectar Life Sciences are in a race to acquire that company. So we could see some positive reaction there. RCR has sold 6 warehouses and then leased them back. And this is to move towards an asset-light model. That's according to an ET report. So watch out for that name. JBM Auto, where its Italian JV partner has terminated its agreement. Sanghi Industries have approved fundraising via debt, and Mangalam Organics, which will buy back 6.10 lakh shares at 230 versus the current closing price of 207. So quite a few names actually.
Okay, so those are some stocks and news. What about the results that came out post-market hours? What stood out?
We have a couple of good names, but I doubt the degree of reaction that the stocks will actually show. In terms of Thomas Cook is the first one that we're picking up. The company has reported a net profit of around 10 odd crore as compared to a net loss. EBITDA for this company is more than 2.5-fold. It's jumped more than 2.5-fold at a number of 120 odd crore. Margins at 4% as compared to 2.7%. Next on the list we have 3M India. There also it's a good show. Net profit more than 2-fold jump there. 92 crore is the net profit that we're looking at. Operational level also the company has performed decent enough, up 94% year-on-year basis. Third on the list we have Mirza International, good show there. Net profit up by 21% year-on-year basis for this company. EBITDA has risen by 14% at a number of 46 odd crore. Margins have expanded to good to 18%. Tata Metallics, that's a stable set of numbers coming in by this company. It's been a good show quarter-on-quarter basis as well as yearly. If you look at the revenue, it's up 63%. Net profit more than 100% jump. EBITDA is good 70 odd percent. Then you have United Breweries, where the operational performance of the company seems to be in line. However, the bottom line seems to be a bit miss. This is mainly on account of the lower other income. Net profit is down by 3 odd percent and EBITDA is up by 19 odd percent for this company. In terms of weak set of numbers, we have Pokarna, where the net profit has come down by 21% and EBITDA is down as much as 6% on year-on-year basis.
Yeah, a couple of good names out there. Actually 3 or 4, but let's see if they react or no. Okay, what about Tata Motors?
Neeraj, they will be coming out with numbers, and this time again we are expecting some volatility to continue for the company on the foreign exchange front. But if you look at the Bloomberg Quint third quarter consolidated preview, we are expecting the revenues to be a little over 74,000 crores. That will be a growth of 16%. EBITDA also, because of a lower base last year, we have a 47% growth expected. EBITDA seen at 9,200 crores and profit seen at close to 2,500 crores. Margins for the consolidated entity are seen at 12.4%. However, if you look at JLR, we are looking at some improvement which can come in. Margins are expected to be 12.5% for the JLR entity. However, this time brokerages like Morgan Stanley expect a third quarter foreign exchange loss to stand at close to 350 million British pound, something which was there at a similar level last quarter as well. So the foreign exchange woes will continue for the company according to expectations. Domestic business would show a strong turnaround. In fact, brokerages are expecting their margins to improve substantially to a level of 8 to 10%. Of course, domestic volume growth of 29% will be driving the margins. And if you look at the standalone profit, brokerages are expecting 130 crore standalone profit after a quite long time, because usually we see a 600 to 1,000 crore standalone loss, and probably this time they will be turning around their domestic operations. So that is one thing as well, apart from the JLR margins, which needs to be monitored quite closely.
Okay, we will watch out for all of these. Thanks a lot, all three of you. Rajat, autos, they seem to have had a good month. There's one number that is going to come out today as well. Maruti has some Suzuki board meet to look forward to as well. Anything within this pack that you keeping on your radar, not necessarily for a purchase right now, but maybe at lower levels?
Actually, we have Tata Motors in our portfolio, and we purchased it at obviously levels higher than where it is right now. I think that's one stock which has been undervalued for a fairly long time. One after the other, things have been going negative for them. First, there was this huge standoff with China, which remains their biggest market for sales. Then there was a lot of brokerages which came out with reports not very positive on the stock. My sense is between Tata Motors and Maruti, the differential in valuation is, it's not justified based on, the markets that they have. Today you get Tata Motors for, valuations of below 10 or thereabouts. So, these are times when you buy these stocks. These stocks don't move, as I was saying earlier, these stocks don't move in constantly, straight line up running kind of markets, because in those kind of markets, the flavor of the month really does not change. But to me, if you look at Tata Motors the way it is, I think nothing justifies why it should keep trading here for a long time. As I said, if there is some temporary disruption and reallocation of capital, irrespective of these worries of foreign currency revenue could be down for this quarter. And I'm talking more sort of 1-2 year kind of horizons. At 380, these kind of levels, you should actually just buy it and hold this in your portfolio. This will give you very, very good returns going forward, irrespective of what happens to the markets in the short term. Besides that, we're also holding some of the two-wheeler stock. Again, those are portfolio holdings, and we don't really sell them very quickly.
Okay, stay on, Rajat. So much more to talk about. So, well, let's sound advice, but let's talk about the day's trade now. And Rahul, Randeria as well as Ruchit, Jain join in with their sense of the charts and what to do in a scenario like this. Gentlemen, both of you, thanks so much for joining in. Rahul, what are you doing with your trades today? With an assumption that we'll start off about 1% lower, say around 10,600 thereabouts, what does an average trader do, Nifty trader do today?
Yeah, good morning, Neeraj. If you look at the last two trading sessions of the daily candle has been totally on the way of the downside, which has indicated some sort of weakness and some sort of the disruption in the trend what we have seen. And to be very frank, about 10,800 we were cautiously bullish, but looking at the global setup and US 10-year bond yield spiking up, which we have seen across the globe, the markets melting down. So definitely today it is just a gap down opening should be used for the investors. Those who wants to invest for long-term investment for at least maybe 2 to 3 years. But definitely for day trade, it would be a very difficult trade for today. Looking at the larger degree trend, the trend started from the levels of 10,033. It ended around 11,171. Currently, this means Friday's closing was just near the retracement of 38%. Now, looking at today's setup, I feel that the trend could slow down or take some pause around 60% retracement mark of that particular in the recent past, the rally which we have seen from 10,033 to 11,171. It could take a pause around 10,467, which is a 61% retracement of that particular rally. So definitely today's gap down opening, one should avoid trading on indexes, but definitely on stock specific action where major of the price erosion has happened. Trade a long-term investor can start accumulating in short and slow and staggered manner. Maybe 30% when deploy now, wait for some more correction, let the price to settle down, in frontline stock as well as mid cap stock, and then take a call. But one needs to wait for the price, the intensity of fall to get narrowed down.
Okay, Ruchit, how would you be trading the index though?
Yeah, very good morning, Neeraj.
Good morning.
Neeraj, if we just see the recent entire rally which we had seen from the month of December 2016. So in entire this up move from 7,900 to 11,200, we had seen corrective moves about 3 to 4 times. Now there were two types of correction. Sometimes it was a kind of sideways correction, and a couple of times there was a price correction as well. So whenever there was a price correction, we had seen that the prices have corrected up to 61.8% of the previous up move, which also coincided with the 89 EMA on the daily charts. Some similar price congestion is getting around at this time also. The recent up move of 10,030 to 11,170, 61.8% of that entire up move is coming around 10,470, which also coincides with the 89 EMA on daily chart. So I think this corrective move, yes, would get extended up to 10,470. That's what we are expecting in near term. And this entire corrective moves in last couple of times we have seen, they have not been a straight corrective move. There have been correction, a bounce back, then again a third corrective move to end the correction at lower levels. So I think from 10,600 we would see a bounce back in Nifty. So today if intraday we see 10,600 kind of levels on the Nifty spot, I think Nifty should again give a bounce back from those levels at least up to 10,800, 820 levels. Then again we should see correction up to 10,470. So if anyone is trading from a intraday perspective, then around 10,600 one can look to square off their short positions or even create long positions with stop loss below 10,550, just a stop loss of 50 points, and expect a bounce back up to 10,800 levels. Square off again the long positions at 10,800 for probable target around 10,470.
Okay, so that's a lot to do. So I hope you've heard these answers correctly. Let's nail it down to specific stocks. Or actually, maybe before I do that, let's get in Jayesh Khilnani on our special segment Bloomberg Edge, because unlike usual, wherein we talk about a pattern that's come up on a specific stock, Jayesh has picked up a Nifty chart today. Jayesh, why this change?
Morning, Neeraj. That's because two of the proprietary indicators on Bloomberg, those have turned negative as of Friday's close. So namely Trender and Fear and Greed indicator have turned negative. Now first let's have a look at a brief of how the Trender and the Fear and Greed actually move. So the Trender indicator uses average true range as one of the key inputs for calculation, and if you look at the Fear and Greed, that actually uses is a spread of two weighted moving averages of true range. So both of them are on the concepts of true range, and they give you buy and sell signals. So you buy when both of them they turn red turns into green, and you sell when green turns into red. So the colors is what you have to follow on the Trender and Fear and Greed. The first panel shows you the Nifty chart for about last 6 months, and you can see that the Trender indicator, so the green line, that has been actually breached, and the stock price has actually closed below. In this case, it's the Nifty index that we are referring to. So that has turned negative. And on the same day, which is Friday, we saw that the bottom panel, which shows the Fear and Greed, that has turned negative. And if we zoom into this, we can see that there's a red bar after a long session of green bars that we had. Both the proprietary indicators followed by Bloomberg, those have turned negative for the Nifty, indicating there might be further downside.
Well, that's not a surprise. The question mark only will be how much and do we pick up a little bit. All our technical experts seem to be believing that there is possibility of some bit of a pullback from key levels ranging anywhere between 10,500 to 10,400 odd. At 10,600 to 10,400 odd. Three experts, three different levels. Before we get back to Rajat Sharma, just a quick question on specific stocks to both our experts. Rahul, to you first. 2 stock ideas for the day.
Actually, Neeraj, looking at today's gap up, it would be very difficult for trading. But some of the stocks which were very strong, looking very strong till Thursday, but again some sort of deviation in the trend has been seen. So definitely we could see weakness in HDFC Bank, where the stock has taken a pause around 2010, and on Friday we have seen a trend breakdown. means a break of a trend, and we have seen some sort of a selling pressure at the higher levels. So maybe if the one can trade on pullbacks, intraday pullbacks till maybe 1940 to 1950. Short to medium term, the positional target would be 1890 on the downside, and one should place a strict stop loss of 1990 on the upside. Second sell call would be in HCL Technologies, where stock was struggling and making some time correction. But looking at today's gap down, we could see that the stock could turn into a price correction. So definitely one can go short in HCL Technologies. Stop loss would be 1014 on the upside, and in short to medium term, we can see stock testing the levels of 891 on the downside. So definitely one should wait for pullback on intraday basis after the markets open, gap down, and then one should go short.
Ruchit, what about you? Your trading strategies?
Yeah, I have a couple of sell recommendations. Both have a similar chart structure. The supports have been breached, and both the stocks are headed towards the 200-day moving average, which is a long-term, which is usually acting as a long-term support. The first one is Motherson Sumi. One can go short with stop loss about 363 for potential target around 334. And the second one is V-Guard with a stop loss about 224. One can sell for potential target around 201.
Okay, so those are a couple of ideas from Ruchit as well. Jain, stay on. Lots more to talk about. Just want to talk, I know a lot of specific stocks will be out of the equation completely, but we had a chat with Vakrangi management as well on Saturday. There's some clarification that they've given, but those stocks are under the eye of a storm for different reasons. A lot of corrections have happened already. Rajat, did you, I mean, I'm sure you've looked at the saga, but did you by any chance have these stocks in your portfolio ever? And what would your advice be to somebody who is holding on to these stocks even now, both Vakrangi as well as PC Jewelers?
Yeah, in my experience, every time there has been some, cloud of bad management on any of these companies, typically there could be some bounce back in these stocks. As you saw in PC Jewelers on Friday, it fell a lot and it bounced back after a clarification. Then there was a corporate presentation in which, Vakrangi first said PC Jewelers is one of our, the key clients, and PC Jewelers denied they have anything to do with the company. So, there was a question mark again on which of the two is not being honest about it. So typically these kind of stocks actually, in my experience from past, suffer for quite a bit. Again, having said that, also Vakrangi as a stock has run up quite a bit. And, you can't expect a stock to keep running higher and higher with, no new clients being added. In fact, the existing clients getting into some kind of uncertainty over whether they're clients in the first place or not. So I'd like to actually stay away from both these stocks. PC Jewelers, these jewelry stocks anyways, I like these stocks because, you never know how much of the revenue is actually getting reflected on the books. It's a lot to do with what the management does with their, inventory management and stuff. So I don't understand their books anyways. The sectors, as I said, that we are looking out for and we've actually invested post the budget, when I said we moved money, was again IT and some of the FMCG stocks. So I think going forward, those are the sectors where I'm looking for some higher levels, and yeah, that's my sense that that's what should do well.
Okay, in about 3 minutes from now, we'll have the markets, the pre-open rates come in. Let's not press alarm bells here. Remember that the growth scenario, at least, if not anything else, is looking like picking up. The world growth has been on an uptick. The earnings season in the US, from what little I've read, is okay. The Indian earnings season has shaped up pretty well. You can argue that a lot of companies are meeting estimates, but that's because analyst estimates have moved up. Are these good numbers? That's the question you've got to ask yourself, and the answer to that is arguably yes. So there may be intermittent blips as the ones we've started to see. Does that mean all is lost? I don't know. I don't know if we can say that confidently. And remember, all through the day today, we're going to be answering that very question. Will the micro come to aid when the macro looks like changing quite a bit from what it was in 2017? Rajat, any results that has stood out for you in the last couple of weeks? There've been a clutch of very good performances, but I'm sure there's one special number that comes to the mind of every investor. There are a few that I have in my mind too as a stock market commentator, but what about you as an investor?
Yeah, Yeah, so lots of them, Neeraj. You know, if you look at the performance of HDFC, HUL, Reliance in particular, I thought was really surprising because, you know, for all that it's worth, you know, a lot of people said that, you know, Jio has actually not made any profit. They've got a, you know, loan from Reliance's basically, if you were to split the companies from the refining and petrochem business, and that comes in the form of, you know, non-interest bearing preferential shares and stuff, and that's why the profits look better. But if that's the case, then how can the company overall report a 20% plus kind of improvement in profits? One thing that I will add is that, you know, you're comparing this against profits from a quarter which was actually quite weak, because this was the quarter from which you're comparing it, which is when demonetization happened last year. So that's also why, you know, the results could be looking so positive that they're, you know, beating estimates or higher than. But then, as you said, they're actually better than most analyst estimates as well. So while the results look better in terms of, you know, what's the improvement in net profit year on year or stuff like that, they've actually beaten a lot of analyst expectations as well. Another thing that sort of stood out for me was the sense I got from most of the management guidances on IT was that, you know, somewhere they believe that the worst is over and it's behind them. Obviously, everything in IT, you know, TCS, Infosys, everything was Wipro, everything was pretty much in line and, you know, didn't improve a lot. But, you know, the guidance was not any more negative. They either maintained their guidance or are, you know, suggesting better days ahead. So for me, for most part, I think that, or maybe it's some kind of a confirmation bias that I'm looking for, because my own sense is that IT, you know, once they get onto the whole digitization, once they get their act right, which I think Indian companies are best at.
Rajat, I'll have to cut you in because the pre-open rates have kick-started. I believe we have to thank you at 9 as well, but I got your answer. Thank you so much for joining in today and giving us your thoughts. The pre-open rates have kick-started. Look at the Nifty 50, 227 points down. This may not be the case. We may not end up so low. We may probably start off about 1% lower. But the pre-open rate's always exaggerated. The Sensex 2 not showing a true picture. I think these rates will change meaningfully. Let's bring up some of the Nifty 50 names and just try and show you what's putting that excess pressure. Like I said, you know, we won't have a 10% downtick in Sun Pharma. That's not going to happen. So those exaggerated moves in Sun Pharma, in a UPL, in a Tech Mahindra, etc., will all recover a bit, and that's why you will see these rates changing. I don't think we'll have the green that the Sensex is showing either, but let's wait and watch. Remember, Friday's weakness was led predominantly by Reliance Industries, the HDFC Twins. Maruti Suzuki was down and out in Friday's session, and let's see what those will do in the session today. With market showing some corrective moves, will those continue to go down, or will there be some bit of buying that could come in? Keep in mind, for both the HDFCs and HDFC Bank in particular, an upcoming fundraise as well, and that should actually help the book value. That was indeed the trade that most people were playing with. Does this correction give you the chance to come back at that? I know a lot of people would say yes, but keep in mind that in a market pullback, those normal valuations that are assigned to a stock in an uptrend don't really happen. Is the uptrend broken? I'm not saying that at all, but just don't be a braveheart and look at the previous calculations and try and trade these stocks is all that I'm trying to say. Now Sun Pharma stabilizes, Yes Bank stabilizes, Tech Mahindra stabilizes a bit. We have about 1.5% or a quarter that kind of a downtick that we're seeing on the Nifty 50. What about specific stocks at the broader end of the spectrum? Vakrangi, well, clarifications coming in from the management, not helping the stock though. The stock is down another 10%, 236. PC Jewelers is down another 10% as well. In a scenario like this, at least the pre-open rates seem to suggest the market is not liking anything at all. Trent is showing a 19% downtick. Again, I don't think that will happen. So let's give these rates a chance to stabilize and then come back. Okay, now Trent has stabilizing a bit. The currency, remember there was a dollar strength in Friday's session. The dollar index is a big move upwards, and the rupee starting off about 12 pairs lower. So not really a big crack. The 10-year bond yields will also come up, as Ira was saying, that there is a marked up till there. Just that in Friday's session, the bond markets were a lot more stabilized. Let's get in a quick perspective here from K. Hariyar. He's head of treasury at First Rand Bank, joins us right now on the show. Hari, good morning. Thanks so much for joining in. What should one watch out for when it's trading the currency and the bond markets? Because there was remarkable dollar index strength in Friday's session.
Good morning. I think basically the dollar index clearly reflected the fact that, the payroll data which came in was very, very strong. And that was also getting reflected in the fact that the bond yields in US have gone up. You would have noticed that the 10-year yield has gone to 2.86. So overall, I think the fact is that the US seems to be set for a decent recovery, and therefore the 3 rate hikes that have been speculated upon are probably going to be a very good reality. Having said that, the dollar index is still trading 90 and below, and that's going to be something that supports the rupee. Also, the fact that Brent has come off the highs of 70 and is trading at 68 odd levels is going to be also slightly rupee supported. But where the rupee is going to pay a price a little bit is probably sentiment. If the stock markets look very negative, then obviously it starts playing off on the dollar rupee. So rupee could weaken a little bit more. It could go to that even 64.25, 64.50 levels. But at those levels, you should see extremely strong exporters selling, and that should get the rupee back to that 64, 64.25 range, because every time the rupee weakens, exporters are selling, because on a longer term basis, we still believe that given the strong macroeconomics that seems to be there in India, there will be a lot of these carry trade happening, and the rupee should continue to benefit from a general, weak dollar despite the intraday moves.
You're actually batting for the dollar weakness to continue. There is a lot of commentary that's coming over the weekend, Hari, about how the dollar weakness that we've seen until now might start reversing a little bit. You don't believe in that?
Yeah, there are contradictory factors at play. So while the U.S. Economy seems to be looking good, even the last GDP print that came printed below expectation, but was a strong 2.5%. But there is a clear sense from the U.S. government that they would prefer the U.S. to A, become a manufacturing economy, and B, supply to the world. So as we also saw in Davos, there were clear statements saying that they wouldn't mind a weak dollar index. So that's one thing that seems to be telling the market that they would prefer a weak dollar index. Secondly, the fact is that they have given away a whole lot of tax incentives. So while the Dow Jones may look stronger on a medium-term basis and corporate profits will look good, it is a fact that the government revenues in the short term may look a little bit weak, and which is why you saw the U.S. yields going up. So in the short term, there are going to be pressures surrounding the dollar index, and that should be emerging market supportive. But the big news everywhere will be the fact that the stock market is looking very weak, and that will obviously cast its own shadow on all the currencies.
Okay. Hari, I'll leave it at that. Thanks so much for taking the time out and joining us with that quick perspective. STS Arya from First Rand Bank. Well, no alarm bells on the currency, I would presume. Before we move any further with our guests, let's get in Somit Sarkar, who joins in with the big brokerage calls for the morning. Somit, good morning.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is Macquarie on Bajaj Auto. Now, they have maintained the underperform rating on the stock, but have raised the target, but have also maintained the target price to 2,900 rupees. Now, in the third quarter of financial year 2018, the company reported lower than expected operating performance. Now, the sales volume grew 18% in the third quarter, driven by strong growth in the three-wheelers and also in export. But on the domestic motorcycle front, the market share has continued to decline as the company's new models have not been able to sustain the initial momentum that it had seen. Now, the exports grew in the third quarter of financial year 2018 strongly because of a low base, and going forward, the near-term outlook on the three-wheelers is positive, but the company is expected to see a slower growth in its domestic motorcycle industry in financial year 2019. Now, second we have is JP Morgan on Hindalco. Now, they have maintained their overweight rating on the stock with a target price of 335. Now, in third quarter of financial year 2018, the company reported a miss on its operational and on bottom line front. Now, the standalone operations of the company did not fully capture the earnings growth according to the brokerage. Now, prepayment of debt has continued on Hindalco's front because of the strong cash flow generation that the company saw in the third quarter of financial year 2018. However, going forward, the upside is limited according to the brokerage in the fourth quarter because Coal India has hiked the coal prices in this quarter. Also, capital allocation by Hindalco will be a key monitorable according to JP Morgan. Third, we have a CLSA on Godrej Properties. Now, they have maintained their buy rating on the stock, but have marginally reduced the target price to 1,058 from 1,078. In the third quarter of financial year 2018, the results of Godrej Property were below estimates because of lower margins. Now, the cash flows, however, were good, and which also saw a net, because of which the company also saw a fall in its net debt. Now, pre-sales have continued to surge in the third quarter. It was up 77%, indicating a major scale-up in progress. Also, project additions continued in the third quarter because of exits from smaller player. Now, going forward, Godrej Properties is expected to be a key beneficiary of consolidation and exits of smaller players in the real estate sector. Also, for CLSA, Godrej Properties is the top pick in the Indian real estate sector.
Okay. We'll watch out for those names. Thanks a lot for that, Somit. Just markets as they stand right now at the end of 8 minutes, the Nifty and the Sensex rates should now come up on your screen because the pre-open rates have settled, and 1.5% down for the Nifty 50, Sensex down about 1%. So we'll start off about 1.5% lower. The Nifty Bank seems to be the principal culprit, and a lot of pain out there. Rahul, the Nifty Bank, how do you approach trade here?
Yeah, again, same thing has happened in the Nifty Bank also, that prior to Friday's trade, it was moving sideways at higher levels and was showing some sort of exhaustion. But frankly speaking, we were also bullish at that particular time, and we had a target of 28,200. But again, looking at the global setup, we have seen that, some sort of deviation in the trend. And exactly the trend which in Bank Nifty which we have seen, which started from the levels of 23,600, it ended around for the short while, it ended around 27,600. So definitely from current levels we could see this retracement up to first support would be coming around say 26,100, and then second support would be around 25,800. So that would be the area where one has to look out for. After today's gap down opening, one has to wait for, as we said earlier, one has to wait for the market's intensity to get narrower, price to get settled down, and then take a call. But definitely we could see Bank Nifty also testing the levels of 26,100, and after that 25,800. So definitely we will be looking out for those particular area, and then we will take a call. But at this point of time, where would be the trend reversal, it is difficult to comment.
Surely. Just wondering, but there is only one index stock in the green in the pre-open session. A clutch of names falling about 2.5–3% odd in the session today. Any banking stock, Ruchit, which is top of your mind? A lot of these were very, very weak in Friday's trade. The Nifty Bank pointing towards this 2% downtick, which means private banks would be down today. Any banking stock that is apt for a trade?
Yeah, Neeraj, rather than private sector banks, I think it's the PSU banking basket which should see further sell-off. The prime reason is that in the entire up move in the Bank Nifty index, which we had recently seen, this was the PSU banking has not participated as well. And when the markets are falling, the Bank Nifty banking stocks are falling, these are the names which are showing, which are falling much more than the index. I think Union Bank is one of the stock which is showing a gap down opening and is indicating a breach of its support. Andhra Bank is another one which is again showing breach of its previous supports and with a gap down opening. So these would be the two names where if anyone is looking from an intraday perspective, then one can look to short on.
Okay. Jain, let's tell viewers all that they need to know to stay ahead in trade today before we take this conversation any forward. Remember, there's a meltdown in global equities and commodities. Asia trades lower by 1.5% in the session today, so that global market picture is looking very, very wobbly. Bosch, Tata Motors, Colgate, Ujjivan and Cochin Shipyard are amongst the companies that will report numbers today. Strong results came in from 3M India, Mirza International, United Breweries, Tata Global and Glaxo Pharma. Let's wait and watch if these stocks react positively today. Strong numbers from Aegis Logistics, Manglam Drugs, RPG Life, Thyrocare, RT Industries and Relaxo Footwear. However, no big upside seen in any of these currently in the pre-open rates. And weak session or weak results for Pokarna, Inox Wind, Jindal Drilling and Vinati Organics. Last but not the least, in terms of bulk deals and buys, Northern Trust Global buys into Camlin Fine, while India Bulls AMC buys into UCAN India. Well, it's certainly not showing like there's going to be too many gains into any of the stronger names. So except for a Thyrocare, we haven't seen any of the other stocks really start off in a big way. The question only is if there is some weaker hands that will continue to look wobbly as the day progresses. Hindalco, which is hitherto a fairly good stock, but testing some of the lows, is looking slightly weak. Ruchit, I did hear you mention about Hindalco at the start, didn't I?
No, we had not discussed about this, but probably if I just see the charts, then definitely the stock seems to be heading towards its 200 DMA support, which is placed around 232. So we could see further sell-off in today's trading session, and specifically if we see the metal packs, then definitely the Nifty Metal Index is looking much weaker than the rest of the indices. So I think the entire metal pack could be under pressure in today's trading session, and Hindalco I believe would test at levels around 232.
232. There are some strong downticks that are emanating in Jain irrigation the last few days, Rahul. I'm guessing a lot of unwinding, yes, post-budget. The stock starting off weak again today. What do you do here?
Yeah, if you look at the Friday's pattern, it was a strong hammer, means a hammer with a very long shadow at the lower levels. So definitely, if you look at the particular pattern, where the psychology of this pattern is that the price in the coming days or in the immediate future would trade between that particular lower shadow, which comes in the range of 117 on the upside and downside 100 rupees. So definitely the stock could consolidate, because previously the major resistance was around 115, 117. Now it has become the support. But definitely at this point of time, where the stock will take a pause, it is difficult to comment. But I feel that looking at the past history, stock would consolidate in this range. It would be highly volatile between the range of 117 to 100 rupees. So trading would be difficult, but one needs to wait for stock to again go down to the levels of 100, 105, then take a fresh call, or at those levels one can start accumulating in slow and staggered manner.
Well, certainly looks like 107 already, so 105 probably would be kissing distance. Ruchit, very quickly, one thought on future consumer. That one's down 7% again today.
Most of the mid-cap names, we have been witnessing a sell-off in last few trading sessions. I think Future Consumer is also one of the stock which has witnessed sharp sell-off from the higher levels of 77, 79 levels. On the lower side, the stock has support around 51, followed by 46. So I think one should not do any kind of bottom fishing over here unless we get a reversal pattern on any of these supports.
So let's try and nail it down to that one top idea. Ruchit, one stock for the day today, very quickly.
Well, we have mentioned about Hindalco, and I think I would recommend to go short on Hindalco for target around 232.
Okay, top shot from Ruchit Jain, Hindalco. Rahul, very quickly, your top stock for the day.
Sell in Yes Bank, stop loss 356, downside target 335, short to medium term.
Okay, sell to large caps. Yes Bank as well as Hindalco is what our technical experts are recommending. Gentlemen, stay on. We'll just take in opening thoughts post the market open, but this is what the equity markets are doing this Monday morning. You would expect a tick of red out there, 1.5% lower for the Nifty 50. The Nifty Bank is the principal culprit there, 500 points down. I won't be surprised if the HDFC Twins are amongst others which are putting this pressure, because the private banks have to correct for the Nifty Bank to be down 2%. But a sea of red, the heat map will look terrible. I'm laying a bet that except one or two names, will not be too many names that will be there in the green on the heat map as well. It's an all red. All the stocks have started off in the red. This is the first time in 2018 that I can confidently say that we've had a start wherein all the Nifty 50 names are trading with a red. There's no point of guessing which stock has performed worse than the others, because almost everything is under pressure. IT is probably faring a bit better, a bit of defensive nature to that space. But just look at the tick of red on the screen. This is not a great start. I don't need to say that. I mean, viewers can view it any which ways. But banks are looking slightly weak. ICICI Bank is down. There is weakness in Yes Bank. Bajaj Finance amongst the NBFCs is down about 3.5%. Axis Bank is down about 2.5% as well. I'm looking out for the HDFC Twins and trying to see where they are. HDFC is down about 1%. I believe HDFC Bank too should be down about 1%, 1.5%. Yes, indeed. HDFC Bank down about 1.5%. So save for ITC and now Tata Motors, maybe an Infosys, but these were short trades really. They will, small time trades. They will really not matter too much. ITC is probably the lone ranger post the budget. No negative is good news, and that one is trading okay. Otherwise, a lot of pressure. Bajaj Finance is now down 5%. Remember, it came out with a good set of numbers. Bajaj Finance is down 5%, and this is a stock that is already significantly off from the kind of levels that it was trading at. What about the mid-cap end of the market? A clutch of names that you should be watching out for. There were weak hands in Friday's session, and let's see what's happened to some of those in today's trade. So Vakrangi and PC Jewelers. PC Jewelers is not in the red, which is probably a good sign. But Vakrangi continues to slide lower, down under 10% in the session today. Some other names, some weak numbers and some strong numbers as well. Firstly, PSU banks. I think Ruchit spoke about these two, and they've started off lower. So 5% down for Union, Andhra down about 3%. I'm guessing a clutch of other names are looking slightly weak. And then the top losers, at least at the start of the pre-open session, were Trent, Jain Irrigation and Future Consumer. And look at the pain that has come in a Future Consumer, in a Jain Irrigation. Future Consumer, I remember, went up to 82. Bunch of brokerage notes out there, higher target prices. The stock is trading at 54. That's the weakness that we're seeing at the broader end of the spectrum as well. A clutch of other names, I'm sure, but let me just get in a quick opening thoughts from both our experts as well. Ruchit, anything that pops up on your screen in the first couple of minutes of trade?
Randeria, we were earlier talking about 10,600 level, which is the 50% retracement support. So I think from intraday perspective, one should avoid creating fresh shorts in the index front. Yes, one can go stock-specific opportunities would be there, but at least I won't recommend to go short on index. I think we would see a pullback move today in intraday trading session.
Okay. Rahul, anything that pops up on your screen? Something in the first 2 or 3 minutes of trade?
As of now, Neeraj, looking at the today's gap down, and the price will take some time to settle down. But definitely trading for intraday would be very difficult. But yes, as we discussed earlier, that for long-term investment, this would be used as a buying opportunity. At least one should start buying in slow and staggered by maybe 25 to 30%. One can buy for long-term investment because nobody can predict the bottoms and tops. But these are the opportunities where one should not, lose. So this price correction or any severe panic should be used as a buying opportunity. At least in the frontline stocks. So I would rather avoid going for trading on intraday basis, but definitely if you look out for the stocks where the prices have come to a very investable levels. So definitely I will look out for frontline stocks where the prices are good to enter at the lower levels for long-term investment. So definitely one can start accumulating at least 25 to 30% at current levels.
Okay, thanks a lot for that, Rahul, as well as Ruchit. Really appreciate you gentlemen taking the time out and joining in. Let's get in the fundamental voice on the show. Andrew Holland, CEO at Avendus Capital Alternate Strategies, joins us right now on the show. Andrew, good morning. Thanks so much for joining in. It's probably not as bad a morning as the first tick showed, but it's not a good morning for sure. What's happening, Andrew? I mean, what's changed between the last week and this? Is it the budget? Is it bond yields? Is it a combination of a lot of factors?
I'm sorry, I can't quite hear you.
Andrew, can you hear me now? Okay, we'll just try and repatch that line with Andrew Holland in just moments from now. But that will be my question to him, really. By the way, as we speak, the Nifty's come off from the lows of the day, but that doesn't really put an end to the pressure. It's still down about 1%. I think Abhijit Pathak was talking about how the Dow was also trading close to supports. You'll always probably see this bounce back from the support levels. The question mark only will be whether that will be sustainable or no. Speaking of specific stocks, I think there is Bajaj Finance, which opened about 5% lower, currently down about 4%. Commodities have taken a beating today. Vedanta and Hindalco are looking wobbly, 4% down for Vedanta, 3% down for Hindalco as well. And private banks are looking weak as well. Okay, let me try again. Andrew Holland, can you hear me?
Yes, good morning.
Good morning, Andrew. Thanks so much for joining in. This is Neeraj here. What's changed between last week and the current performance, Andrew? Is it the budget? Is it bond yields? Is it a combination of a lot of these factors?
It's a combination of a lot of factors. Obviously, global markets are now fearing higher bond yields and what that means. And we're starting to see a lot more volatility in global markets, and that might continue for a little bit longer. I think as regards our budget, whilst fundamentally we see nothing wrong for the economy, the imposition of long-term capital gains tax, I think, was a bit of a shocker. And I think clients and investors now are just kind of realigning to the kind of returns or lower returns they should be expecting from markets going forward. So I think there'll be a lot more volatility in our markets. But fundamentally we're not overly bearish, but we've been expecting this correction. We talked about it many times from a liquidity viewpoint, and maybe this is what the markets needed. But it's I think, with the imposition of tax, I still think it's kind of the mid caps and small caps which will probably take the burden of this downfall.
Okay, so Andrew, when you're speaking about a correction and a downfall, do you think we are amidst one already, and how much further ballpark can this correction drag us down? Would it be to the extent of 2, 3, 5% at best, or could it be worse?
So I think, we're probably 5% will probably get baked in very quickly. And it's really then, what the volatility is looking like globally as well. So I think we'll follow global markets for the next few days or so. And if that continues, then we'll just get dragged down. So I think 5% is probably a stop where, we could look at see what's happening globally. But it's going to be anywhere between, 5 to 10%, I think, is probably globally what's going to happen as well.
A lot of comparisons, Andrew, in the last 1 month. Some I've done myself about what the valuations or the premiums that the broader end of the spectrum was trading at compared to the historical averages, compared to maybe the large caps as well. Now, the question is, if indeed we are in a corrective mode, and we may not correct more than maybe 5%, but if the mood stays somber, how much of a damage can it do to the broader end of the spectrum? Because I heard you mention that the mid caps and the small caps will bear the brunt of the pressure, but it's not like they haven't done that already. The small cap index is probably down about 15% at least from the recent highs that it clocked in.
Yeah, well, you see, you've had a lot of huge outperformance over the past 1 to 2 years, and again, you know, when I'm kind of mentioning, you know, mid and small caps as a broad index rather than individual stocks, which I'm sure there'll be the winners from this. But what I think now is that, you know, we have a kind of an interesting phase, right, where the macros are looking okay, but there's some headwinds in terms of higher oil prices, higher commodity prices, and the micro in terms of earnings are starting to look better. We expected earnings growth of 15% this year, and I think that's where the market's going to grapple with at the moment. Is you know, should we look at earnings growth and get to more reasonable valuations, because the macro is still looking at, you know, a little less bright than it was, you know, 6 months ago when oil prices were a lot lower. So I think that's where we are, and I think bond yields are telling us that we're probably into a more hawkish RBI this week, and that will keep bond yields higher for longer. And again, you know, if bond yields are where they are, then you do have you know, before we were saying there's no other alternative but equities, but there is an alternative now given the tax. So I think that's, you know, we're going to see this transition or this kind of movement around of people's assets, you know, in the next few weeks as the mutual fund industry gets to grips with where they should be, you know, asset allocating for clients.
Yeah, that's the big thing. I mean, a lot of conversation about how ULIPs could come back to the fore as well. I've seen multiple articles already, and we'll probably try and do some pieces around that too. But tell us, Andrew, are NBFCs already pricing in a very hawkish RBI? Because we've seen some well-performing NBFCs which have come out with fairly decent numbers, taking you know, bearing the brunt of the selling in the last few days as well. Not a surprise, but are they pricing in a hawkish RBI?
You know, what happens, I mean, they've had you know, again, if you go back, they've had you know, a fantastic run. And so on the downside, they'll probably kind of exaggerate that as well. So, you know, it's an area that we're looking at. But, you know, when yields are rising and looking likely to kind of, you know, be the trouble area, then, you know, sentiment-wise, it's not the best place to be jumping in at the moment, even though prices might look more attractive. So, you know, you need to let the dust settle a little bit before you go into interest rate sensitive kind of sectors, just to see, you know, how the you know, the kind of valuations are looking then. I certainly think for the banking sector, in particular the PSU banks, you know, this just lays an extra layer of pressure for them, and some of the you know, some of the results again over the weekend were surprisingly poor. So that, you know, we're not out of the woods yet for the PSU banks, despite recapitalization efforts by the government.
Okay, that's an important thought. By the way, just want to mark PC Jewelers, it's up 21%. So it was down in the dumps in Friday's session, went down to as much as 50%, then closed down about 24%. It's recovering some of the lost sheen in today's session. The stock, though, it's well off from the highs, recent highs. But yeah, some bit of a respite for PC. Can't say the same for Vakrangi though, because Vakrangi continues to go down. There's a fairly strong defense that the management put up in the interview that they did with us on Saturday. That's not really helped investors to meaningfully, at least investors in Vakrangi, whoever would have been left. 10% down now. It's about 4 million shares traded in today's session though. So the volumes are fairly high in Vakrangi in the session today. Andrew, the pocket which is doing well is IT. Is this defensive buying, or is this investors getting enthused by the kind of earnings performance that IT companies have shown, not just in this quarter, but the last couple of quarters now? And what are you doing within your portfolios, within your advice to your clients? Are you still accumulating, buying, heavily buying into IT?
So there's a couple of points there. First of all, You know, in terms of the performance in terms of earnings, I think you're probably there or thereabouts in terms of the, you know, the negativity around earnings. So we moved some time ago from a kind of more bearish stance for the last few years to more neutral, and that's where we continue to be. Of course, in these markets, with, you know, the expectation that the dollar at some point will get stronger as the flight to safe havens, that the rupee will depreciate. So it's a great place to hide at the moment. I would say the two places to hide in these kind of markets will be FMCG and IT. Usually you put into that pack pharma, but you know, pharma still has its own problems which are ongoing. So of the three sectors, you know, it's IT and FMCG is the best place to hide at the moment.
Clutch of well-performing mid-caps, Andrew, have come off quite rapidly. I mean, companies that have delivered great results over the last 2 or 3 quarters, and the commentary has been very strong and robust about the earnings going ahead, are still coming off quite rapidly. I mean, I could place in multiple companies out there, some logistic companies, some of the commodity names like Rain, etc. You know, there is a Sterlite Tech out there in between. So a clutch of these names, which are promising good growth over the next 3 or 4 years, but coming off quite rapidly because of the meltdown. I mean, what would your sense be? Do you think the broader market pressure that you spoke about will continue to be on these names as well? And therefore, even if people have gunpowder or dry gunpowder, would it be prudent to not deploy it right now and wait for the dust to settle?
Yeah, I think so. I mean, you know what happens? I mean, we've seen it before, right? When markets are rising, you know, good, bad, and indifferent companies all get kind of moved up in the same boat, and that happens on the downside as well. Whereas good companies will be, maybe, you know, you're making some good money, they're more liquid, and you know, you can get to sell them more easily, and that's, you know, tends to what happens. So you get on the downside the price is being exaggerated, and that's a great time to be looking to buy. But I think I wait, you know, for the first few days, see how global markets are, and then see where valuations are for some of these companies in the mid and small cap, particularly obviously the main indices as well. So, you know, we can all look for levels. It's difficult to get that, you know, correct level to time to buy. But, you know, if you feel that a company on, let's say it's on a P of 15, now it's on a P of 12, but nothing's changed, then it's a good entry point if that's the valuation you think is attractive. So that's the way I kind of look at mid and small caps.
But what pockets would you have earmarked, Andrew? I'm sure looking at the earnings season, the last 2 or 3 quarters, there will be some pockets which would have been favorites and you would be watching out for. If not now, then when the dust settles, and as you said, it's impossible to time it. But still, the short list of sorts, if you will.
Well, the short list of sectors rather than stocks, you know, continues to be the private banks, which will continue to take market share across the board. So, you know, that's the area that we would look at initially. FMCG and IT, where we're hiding, you know, we'd hide at the moment in terms of the market falls. Will continue to be sectors that we like, and then we'll see we'll see what the damage is and see if we should be looking at NBFCs again in any more kind of serious buying opportunities. And we'll also look at you know, the auto companies and the metal companies, because, you know, whilst we're having a correction in the markets globally and in India, global growth is not slowing, and that's still the good news. So, you know, I think, you know, this gives a good opportunity and entry points into some of those sectors.
To ask you mentioned a space that I wanted to ask you next. What about commodity players? What about metals in particular? They too seem to be bearing the brunt of the selling pressure, and this may well be global in nature, not necessarily just local. What do you do with the Vedantas, the Hindalcos, or a clutch of other steel companies as well?
So, you know, I think again, you know, if you look at the actual overall metal prices, you know, they haven't really kind of come under any pressure because the global economy is fine. This is a market correction, not I would say a correction in commodity prices, because either there's oversupply or we're moving down in terms of growth. So, you know, there'll be a very quick bounce back in these sectors. So this is the opportunity, you know, I said, when the dust settles to pick out the ones you want and enter them for the first time, or add to holdings. That's what we'll be doing. So it's an opportunity rather than anything that I'm worried about on commodity prices at the moment.
Great. Andrew, good having you, as always. Thanks so much for taking the time out, and all the best with your investing process. Thanks for taking the time out today. Well, the market's about 1% lower, so no alarm bells really. But on the other side of the break, we have a very important market conversation about what to do in a scenario like this, what the markets make of the budget, and lots more with Ramesh Damani, member of BSC. He joins us on the other side. Stay tuned.
job, अरे 5 to 9 job, भाग दौड़ all the time job, the roaming वाला job, the deadline वाला job, or are you living in the market वाला job?
Life is full of options. Choose a job and earn on your own terms. Choose to become an LIC agent. It's more than a job. It's career insurance. Be your own boss. Be an LIC agent. Ab life set hai.
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Back with IndianOpen right here on Bloomberg Quint. The equity market's about 1.25% off. Let's get in a very special voice who's witnessed many such cycles, if you can call this one that, and ask him how is he viewing the current scenario, what is his view on the budget, and what should an average investor do in a scenario like this. Ramesh Damani joins us right now to talk about his thoughts. Ramesh, good morning. Thanks so much for joining in. You know, Ramesh, as of now, we have cracks in the dam. Can the cracks widen up further? As a man who's seen many such cycles, many such convergences of global and local events, how are you approaching investing currently?
Good morning, Neeraj. Thank you for having me, first of all. Of course, it's a tough day to be on television giving your views out. But if you go back and search what happened over the last 3 years, say, you've had 3 or 4 occasions when the market has fallen in Sensex terms 600 to about 1,000, 1,200, sometimes even 1,500 points. They happened on Demon Day, they happened on Brexit Day, they happened when the China crack-up happened in 2015. And the market has recovered from all those fairly nicely. So my first get-go to you was that this is a correction in a bull market. Corrections in bull market, for your viewers, always short, sharp, and swift. So they shake out, except the staunchest believers in that market, they shake them out, and then the market resumes its uptrend. It's just kind of a reminder that it's so hard to make money in the market that you have to remain committed long-term in order to truly enjoy the benefits of a bull market. So my first reaction was that the market did that. But then, of course, when you add the global potpourri of events of, possibility of rising interest rates out there, possibility of the Dow having topped off, that gives me some pause that maybe we'll have to weather this storm for a little bit longer. The good news, of course, Neeraj, is that the Indian economy is finally starting to do well. I think the third quarter results have been ahead of expectations of most analysts. There are green shoots of recovery well underway in the economy. A lot of sectors are doing well. So in terms of earnings, at least, I think there's reason to be more optimistic about the market.
How much of a dampener can this have to the overall scenario? I mean, Ramesh, what I mean is, until last week, the entire conversation, not just for India but across the world, was about how growth is looking up. Now this talk of yields in India, the added bogey of the budget and the long-term capital gains tax has come over to take at least center stage on the conversation table. How much of an overhang would that be to the overall earnings growth story that we're seeing, not just in India but across the world?
Neeraj, the two things that global markets haven't had to deal with in the last 3, 4, 5 years, or actually since the crisis, is inflation. I think we were most worried about deflation. I think the data of US payrolls suggests that inflation might be coming back in America. The data in India projects that because of the huge spend on rural India, the huge increase in MSP, that we will be fighting inflation in India in the next 6-8 months. Inflation could rise. In the short run, inflation is not necessarily bad for the stock market because it increases profitability. Costs don't rise as fast as prices rise at that point. So in the short run, it's okay. In the long run, of course, inflation is very detrimental to long-term equity values. So I think the first thing we will deal with is inflation, which wasn't dealt with in the past, which of course implies that interest rates whether in America or India are probably headed higher. In India, we've bottomed out in the interest rate cycle. We're probably going to see a higher interest rates, say over the next 6 months to 1 year. And some of the leading economists and the ex-finance minister have also suggested that. The other thing is risk. I think the Dow has come out from a period of extremely low volatility. I don't think it fell in more than 11 months. I don't think the intraday volatility was any high. But I think markets are now rearing the head of volatility again, so we'll have to deal with that. Having said that, I remain optimistic on an Indian recovery. It might take a little bit longer. I think it takes some time for all the malaise that has been built up into the system, all the excesses to be wrung out. But the question I ask myself, Neeraj, every single morning is that, are we seeing a bull market top? In which case, if we think it's a bull market top, we need to sell the rallies. Or are we seeing a correction in a bear market? I think on balance, if you ask me to stick my neck out, I say we're seeing a very sharp correction in an ongoing bull market.
Ramesh, if I may just add to, I think some of the headwinds that you already listed, and that is commodity prices moving up, crude, not just crude, but I think we've seen that in a fairly sharp metals recovery over the last 6 to 8 months, now. Does that not change fundamentally your stance? Maybe not on the top with regards to the bull rally, but at least a slowing down of momentum with regards to the bull rally for this calendar year, given that where we stand today, everything now seems to have been fully priced in.
Well, you could say that about some mid-caps, but they don't really count. I mean, in terms of the percentage of float to market cap of India, is the large caps count. And if you look at, say, tech companies, pharma companies, OMC companies, they're trading at fairly, reasonable PEs with, actually handsome dividend yields, and companies that have just bought back their shares. So, I would not make that argument that the large cap stocks in India are grossly overvalued. I think because of domestic liquidity, we had a huge run-up in mid-cap stocks, and quite a few analysts have come and warned against keeping on chasing those higher returns. But that's typical of a bull market, that people get complacent and people get carried away and the multiple keeps expanding. And then there's an occasional reality check that as we took place on after the budget. You know, in terms of the market being disappointed by the LTCG, yes, it's disappointed. Anytime you tax people some more, they are going to be disappointed with you know, the additional tax out there. And I think we don't like the framework. I think if the government had, say, made an effort to reduce STT, saying we're going to normalize LTCG but reduce STT, the market would perhaps have reacted correctly. You know, just look at what is the history of tax introduction in India. You introduce the minimum alternative tax at 7.5%. It's above 18% now. You look at the service tax is introduced at 5%, it's 18%. You look at the dividend tax, it's up to 25% from a low single-digit number. So what happens is once the government gets its foot in through the door, it opens it wider and wider and taxes it more and more. So you had a system that you designed, STT, to encourage people to come into the market, to encourage capital flows. And now in one fell swoop, you've discouraged it by introducing LTCG and retaining STT. So the market was a bit disappointed with the fact that the statements coming post-budget also have not been exactly morale boosting for the markets. But overall, can the market live with the 10% LTCG? I think they can. I just think the government in terms of economic policy should align incentives a bit more precisely.
It isn't just, I think, LTCG or the confusion around what this government's tax policy is or what any government's tax policy has been in the last couple of decades in this country. You know, given the persistent increase in cess, the persistent return of some of these things that we thought we had said goodbye to, it's also some confusion on what is the broad economic policy. And I ask you this because I think we go into an election year next year. A lot of the government action this year will probably be led by what outcomes they want next year. How convinced are you that we're playing to a plan? And that plan is of a coherent economic policy. For instance, Manish Chokhani was talking to Neeraj on Friday, and he made this impassioned plea for, more aggressive divestment, saying, why are we borrowing so much money to pay interest when we could be selling off assets, at a much faster pace and finding money to radically change infrastructure in this country? Do you think anything this year is going to change for the better in terms of economic policy?
I completely agree with Manish. I heard that interview, Meneka, and I completely agree with him. And I've been also an advocate of a more aggressive PSU privatization plan. But in the pre-budget, in the post-budget confabulations with the disinvestment secretary, I don't think that is the government plan. That's unfortunate. I think they've taken the centerpiece of Air India, and even if that gets through, I'd be very happy. But that's all they're going to do. They're going to privatize some 24 other PSUs, but there's a very small, marginal, loss-making PSUs. As Manish pointed out, that if you have Aramco getting listed in Saudi Arabia on such a small economy with a $2 trillion market cap, I think there's no reason why we can't disinvest so many of our things. And that's really one of the last major reforms that the government should do, because whether to keep an MTNL on the books, keep a BSN on the books, makes increasingly less sense in a world that's already so well connected. So the government might as well ensure that. And the fact that the government has a clear majority, which it may not have, say, if it comes back to power the next term, is more incentive to do that. That would be the right economic decision to do. If he did that, the market would cheer it. And I'm disappointed that, well, the government has made it clear that it's not in favor of privatization. So they are, in that sense, sticking. But I think the economy calls for some bolder steps. You need to raise resources for infrastructure. And that, as Manish pointed out, is really a good way to do it.
No, but Ramesh, just wondering, there was probably a known fact that divestment is going to be that big revenue kicker for the government. Expectations were for about 1 lakh crore even for FY19. Do you think that's a missed opportunity because the equity markets were buoyant? Without doing any kind of tinkering, you could have had this 1 lakh odd crores or maybe more coming in from divestment. That seems to be a far cry now. Even the government's target is 80 odd thousand.
Yeah, I agree with you, Neeraj. I mean, one never knows how these things play out. Maybe the market, bottoms out at the end of February and then starts to rally again because corporate earnings will be better. Oil prices may come down, which could, provide a boost to our domestic markets at least. Or FI flows may resume because they're leaving developed markets and coming back to emerging markets. Any number of things can, change the cocktail that we are facing right now. But, what was good economics? Good economics was saying, okay, finally I'm going to bite the bullet in terms of the PSUs. I have MTNL, BSNL, and a whole bunch of other PSUs that make no sense from a strategic point of view in India, for a governance point of view in India, and already because technology has overrun these companies. So I'm going to monetize the assets, sell them, just like the government is doing, say, for the NCLT program, taking these unviable private companies that are deeply in debt and auctioning them. The government needs to do that perhaps with its own assets. It is a very important reform, but I don't think successive governments have had the courage in the stomach to go ahead with this. For some reason, it's a politically no-go area.
Okay, Ramesh, the other part is earnings. Now, we just spoke about it. I'm borrowing a leaf out of Menka's earlier question to you as well. While earnings seem to be on the track to revival, there are a couple of things which are starkly different in calendar year 18 versus calendar year 17. One is the commodity price upticks that we've seen, and therefore the hit on the operational picture, as the case may be. Two, in all probability, we'll have a hawkish RBI, if not a dovish RBI. I mean, a dovish RBI is out of the question for sure. We'll probably have a hawkish RBI, if not a stable RBI. What do these two do to the earnings picture for calendar year 18 or FY19, as the case may be?
Yeah, again, Neeraj, I'm not necessarily an expert on the big macroeconomic picture because I tend to look at stocks more on a bottom-up basis. So I'm trying to look at individual companies in that sense. But I think from talking to my friends who understand these things, they tell me two or three things. First, they say that the fiscal deficit, which caused some amount of consternation in this year's budget because it was exceeded, will come in, at the government number next year because they expect fiscal buoyancy. Why do they expect fiscal buoyancy? They think the GST is coming through with some sort of delay, so that will be good. Tax collections, even in the last year, were very buoyant. They were ahead of the budgeted estimates, and because there's a corporate earnings recovery underway, I think even this year they will exceed the targets that have been set in the budget. So the fiscal deficit number will come under control. The RBI may be forced to raise rates marginally because in a world where rates are going up and there could be some inflation, to keep that under control, they will, probably raise interest rates at least marginally in the next 6 months to 1 year time period. So individually, when you look at companies, whether it's cement companies or whether it's, the steel companies, they all are tending to guide towards a more robust year in the current year. And there are then, of course, companies like technology, pharma, that are not exposed necessarily to the commodity price cycle. So maybe you have to make your bets within that area also.
Ramesh, do you believe that the fund flow we've seen come in from retail investors through mutual funds into equity markets over the last 2 years is likely to sustain this year, and notwithstanding cuts like today's, which are temporary? And I think we've seen in the last year or so that retail investors seem to have found the stomach to be able to tide through, some difficult days. But is that momentum something that looks like it will continue? And I think the second part to my question is that typically, since this money is going to a universe of fairly small stocks, right, at the end of the day, how much tougher has it become for these funds to continue offering returns that will keep these investors happy?
Well, that's, Menegas, the million-dollar question. I think the big worry on the Wall Street is that the domestic flow that has been the bulwark of this bull market for the first time in the last 50 years perhaps, may now change because it's no longer that efficient to buy stocks. You're going to be charged 10%, short term is 15%. There's no great difference between short term and long term. So, investors may say, I'll take my chances in fixed income perhaps because it will do better. So there is a big risk on the market. The bulwark of the market has been domestic savings, that even when foreigners sold, India could absorb it, and there was no issue about that at all. And you kind of spooked that brilliant play we had going for the last 2-3 years or so. So, clearly, I would be worried about domestic flow. I think it's too early to try and tell what is going to happen in this. But obviously now equities is going to compete with a lot of other asset classes for the investor attention. So we may even see a slowdown. In terms of foreign money, I think there is some chance because of global economic recovery continuing. Foreign money that has been largely going to America and to other countries might come back to India. So that would, help us. In the last 2 days, foreigners have actually bought into India, maybe 1,000 crores on each of the last 2 days. So that has helped us. you know, Menika, all these balls are juggling in the air. I don't think at least I have the right answers to this. But I can only tell you from my long experience in the Indian market that the Indian economy is on a growth track. I mean, these things will happen and will continue to get derailed over time. But there are businesses that are doing well. There are companies that are doing well. And until proven otherwise, I'm going to remain that this is a bull market. Then this is a correction within that bull market. Menika, the second part of your question, could you repeat? I kind of lost my track of thought on that one.
Second part of the question had to do more with the bottom-up approach that you speak of, which is that, you know, where do you see value in this market? And I think I correlated that to the fact that the bulk of the money that's come in has been invested via mutual funds in a fairly small universe of stocks. You know, maybe there is value to be found outside. Where is that value today? Can you talk us through what you see or find most interesting?
Menika, I think clearly I think the large caps will be re-rated. But when the year began, I think maybe I came on your show or a few other shows and I said, you know, the quadrant that we are looking at in terms of growth, you know, one would be the quick service restaurant or the QSR space, because I feel that plays into the themes that are most promising about India, from unorganized to organized, women working outside the house, you know, lack of domestic help, AC, Wi-Fi, hygiene, all these things that plays into the quick service restaurant. It's a fairly small area with only a few dozen stocks to actually take a look at. But if you do your pick and choosing, these businesses can compound over long periods of time at, you know, 15–20%, because this is very nascent industry in India. I think basically as we move to a more prosperous economy, people will want better hygiene standards, better quality of food, better choices, and a better environment. So that seems like a, you know, a fairly decent area to look at. I think people have been a bit negative on the real estate sector. I think in terms of valuations, they're very cheap, so they will do well over the next few years as Indians want more affordable housing, as the push for affordable housing increases dramatically. We like the gaming stocks because we realize in Asia, across Asia, whether it's in Japan, Indonesia, Malaysia, Philippines, Singapore, all the governments are opening up and legalizing the gaming industry. I think India is inevitably going to follow suit. There are not many choices and they're fairly expensive, but these businesses can get really expensive over periods of time. So, you know, the gaming industry looks good. And then always the area that I'm most excited about, Menika, is what we call the shift from service-led tech to intellectual property-led tech. I think we've made a lot of money over the years on services-led tech. You go get a contract, do the billing system, do the accounts receivable, cost you 100 rupees, you charge 120, and the arbitrage made the stock market investors very happy. But I think increasingly that business becoming more productive, more commoditized. But there are companies that are developing intellectual property, all right? And companies that have intellectual property by definition will have pricing power and will enjoy fatter margins. And now for the first time, I've seen companies move out from the intellectual property model into the, from the service model to the intellectual property model. And I think within that tech space, if we can find companies, small companies under a few thousand crores, which are providing algorithms, intellectual property, I think that will be a great area to invest for the next 3–4 years. I think you have to have a, you know, a very sharp eye for those values. But I would encourage investors to look for companies that are, you know, developing intellectual property. I think that's where I find the sweet spot of, you know, my eyes wake up that there could be, you know, huge moves in these companies in the next 3 to 5 years.
You know, Ramesh, that's a much riskier, if I may call it that, riskier area in tech to bet on than what has become the service-led technology area, because there, once you have the skill set, you're just pitching for larger and larger projects. IP-led tech is a hit-and-miss game. So how do you go about identifying the right kind of companies with the right kind of qualifications or attributes to invest in? You know, that's question number one. Question number two is, in previous interviews, you've mentioned airlines as the fourth corner of your quadrangle of investments. Did you intentionally not mention it today? Or, you know, it's just that you've replaced it with tech as something as more interesting or fascinating to you at this point in time?
Menika, it is harder, I agree with you, but the returns are much superior if you can find these companies. I mean, when you were buying the service companies, people were buying the old economy, but you took a chance on these service companies and they became behemoths in their field. I'm talking Infosys, Wipro, TCS. If you're buying them in the 90s, they were unloved, unnoticed, and people all gravitating towards the old economy, but the pioneers in that made very well. I think there's the next generation of tech companies. The problem with the old companies, Menika, I find, is that while they will do well, they are unlikely to have the glamorous P's of before. So you should be satisfied with the probably, you know, plodding rate of growth rather than some superior rate of growth that we've been used to in the technology company. Some of the younger companies might seem expensive, might seem a bit wishy-washy in terms of operational efficiency, but they're doing very exciting things. And you know, you wake up every morning saying, good, I'm excited about these companies. And I would say companies doing with, say, work with Aadhaar, companies doing work with data, companies doing work with cybersecurity. You know, that's the sweet spot of companies delivering intellectual property. And if you look at what's happened in the West, you know, all these companies, Facebook, Google, Tencent, Alibaba, they're all, you know, companies working on intellectual property, algorithms, negative working capital. So it's amazing how the market has shifted to valuing companies with hard assets to now only value companies with some sort of intellectual property. And Uber, a great example of a company with no physical assets, but having a $50 billion valuation. So I think some of these companies are there for India. The second part of the question with airlines, I'm sorry I missed that. Yes, I am bullish on airline industry. I think the big fear, Menika, everyone has with the airline industry is that with oil prices going down, that will, you know, cap their profits or lead them to losses. But there are a couple of things that have changed within this industry. They have moved from, you know, single pricing, so you pay 5,000 rupees and get everything included, to a la carte pricing. So as you know, when you fly, whether you pay for your baggage, whether you pay for your meal, whether you pay for your seat, everything is now priced separately. So that ensures that anytime oil spikes up, these companies' profitability will not get thoroughly quashed. Plus, they've already introduced fuel surcharges whenever price goes up. And I don't know if you, whenever I travel right now, there's just an unprecedented boom going on in the Indian travel industry. And because of the reputation that it has, you are not going to have new entrants come in. So there's going to be a play of 4 or 5 people in the domestic market. So that means they will ultimately have some pricing power. And so I think the long-term prospects for the airline industry, you know, look exceedingly good. And as you know, Menika, the millennials, the generation that is the future of our country, no longer want to buy things. They want to buy experiences. And you want to buy experiences, you have to get there. So I think airlines will, you know, probably do well. And, you know, I'm fairly bullish on that sector.
Okay.
Okay, interesting. Ramesh, maybe one final question from my end, and that would be on whether you are doing anything in this whole data boom, because there are enough and more stories coming in, whether they are data enablers, whether they are optic fiber companies enabling data to reach you, so on and so forth, whether they are equipment manufacturers. I think a tech company falls within that bucket of providing antivirus solutions as well. So multiple ways to play this data stroke mobile phone enabled data theme. Are you nibbling? Are you biting into this pocket?
Yes, I am. As you mentioned, I had positions in a cybersecurity firm. I have companies that, you know, invest in routers that, you know, help data move. I have investment in companies that, you know, actually provide access to them from a customer point of view. So, you know, the lots of, you know, nuggets that you can pick out, some large caps, some small caps. But, you know, as everyone has been saying consistently, that data is the new oil. So, you know, and I believe that. So, you know, you clearly want to look at, you know, those kind of businesses because they're also bulletproof. I think increasingly, I mean, anywhere you go without Wi-Fi, the thing doesn't work. I mean, you need Wi-Fi. You need to be connected 24/7. That's the mantra of the millennial generation, if you will. And I think if you look at what happened in pattern usages, what stunned me, Neeraj, is that in the US, for the first time out of 50 years, people are delaying getting their driver's license because they don't want to drive. They just want to be connected. You know, they order food in, they, you know, they connect with their friends on social media. They're delaying getting their driver's license. That's how much far the movement towards data has gone. So they're staying home and staying connected through data. You know, I'm not sure that will happen in India, but, you know, I think data consumption is, you know, going to boom, and you have to find different ways to place it. And you have to think about all the ramifications, whether in terms of cybersecurity, whether it's in terms of social media, whether in terms of router networks that you have. So I think there will be a lot of opportunities for savvy investors in that area.
You know, Ramesh, I'm sure that the bulk of your portfolio is just finding these great companies that offer you value and that you want to hold on to for a long period of time. There must be some part of it that is a slightly more medium-term oriented portfolio. At the start of a year like this, when you know that the momentum in markets isn't going to be anywhere as good as last year's momentum, when you know prices are necessarily not going to climb as much, you know, if at all, you know, versus last year, do you change your investment strategy at all? Do you look at the markets with different eyes and say, here's where I'll put my money because it's safer, as opposed to what I would have done last year?
You know, Menika, these are all questions that we ponder with every day. If I felt in my bones that this market had topped out and that we were going to enter a bear market, I would be trying to raise cash. I mean, I don't raise a lot of cash, but 20-30% of my portfolio, I would try and raise cash. Having already told you that I don't feel in my bones that we're not in a bear market type of situation, but more in a bull market correction. The philosophy that I've learned over many years, and this has come through trial and error, is to find great businesses. That's the first thing we want to do. We want to find good managements running great businesses, and then we are happy to hold them for long periods of time. I mean, just like, you know, businesses don't go bad because the market goes down. We're ready to hold them through even an economic downturn. So I think my entry criteria is much more stronger for a business. I want to be convinced that there's a great opportunity, there's a management who has an ability to meet that opportunity, and, you know, I feel that that opportunity should exist no matter what the external environment happens. I mean, even if oil price goes up, even if, you know, interest rate goes up, these businesses should be able to perform. So, you know, we tend to look at, you know, in terms of life cycles of businesses, not necessarily in terms of markets. So, you know, I mean, it may not be the best thing, but we often hold through a lot of very difficult periods in the market. I mean, for example, when Brexit happened, when Mr. Rajan left, when the Donald Trump election happened, markets are down 500, 800,000 points in a single day.
All right, fair enough, Ramesh.
You know, we retain those businesses, and over time, that has been a winning strategy.
Okay, let's hope it's the winning strategy this time around as well. I'm sure bulls are hoping for that. But Ramesh, so good of you to spare this time and join us today. It's an interesting day of trade. Let's see what the week throws out. Thanks so much for joining in today and giving us your thoughts.
Sure, Neeraj. Sure, Menika.
Thank you.
Well, that's an important voice, Ramesh Damani, with his thoughts. He's invested. It didn't seem like he was sitting on large poodles of cash as well. He's...
Well, no, I think he was not. Forget Seam. I think he was very clear. He didn't think that he felt in his bones, as he put it, that was time to call the top to this market. And of course, one day of selling doesn't make for calling the top, right? But yeah, it's going to be a markedly different year than 2017 was. And I think investors should prepare for it, including all the retail investors that put all their money in SIPs over the last 2 years. Buckle up and, you know, watch what happens to markets when things start going from benign to volatile.
Yeah, your NAVs need not necessarily climb up. We'll talk about that as well, by the way, on this week's mutual fund show too. But for now, I think we wrap it up on this leg of Indian Open with news that the markets are a lot higher than what they were when they started off trade. So maybe that's good news. But the FNO show will take forward all of that action on the other side. Thanks so much for watching this leg of Indian Open.